In this video, I'm going to show you how to make money selling cash secured put options. Selling put options is one of the cornerstones of my trading strategy and allows me to make money on a monthly basis through these put options. Make sure to stick around to the end of the video where I share strategies that make selling put options even better and allow us to bring in even more income. There are a few key reasons why I like selling put options, and I think that they're really powerful. Selling put options allows me to generate double-digit percentage gains, whether the market's going down, staying flat, or going up. You don't need the stock market to be going up in order to make substantial gains. Put options also allows me to layer in some downside risk. In the event that the market goes down, I have some built-in protection from these put options. And with put options, I'm able to pick the exact price that I want to buy the stock at and get paid while I wait. I'm able to buy during dips in the market and enter into positions at a lower cost basis than if I were just buying stock outright. These are some of the reasons why I really like put options and think that they should be part of almost everyone's strategy. Selling a put option means we're selling someone else the right, but not the obligation, to sell us 100 shares of stock for each contract that we sell. And they can sell us the 100 shares of stock at the strike price that we agree upon for the contract at any point between the time that you sell the contract and the time that it expires. Let's look at a brief example here. Let's say that XYZ stock is trading at $55 a share. We can sell someone else the right to sell us 100 shares of stock at $50 a share, the strike price, at any time between now and the time that the option contract expires. And for the right to sell us 100 shares of stock at $50 per share at any time between now and the expiration date, they're gonna pay us $100, $1 per share. And I mentioned strike price. The strike price is the price that you would be obligated to buy the shares of stock at if the stock price closes below this strike price at the time of expiration. And the $100 that we would get paid for selling this put option, the $1 per share, this is just an example, but that amount would go up if we're selling a contract with a longer duration, and it would also go up if we're selling the contract at a higher strike price. It would also go down if we're selling a contract with a shorter duration, and if we're selling a contract with a strike price that's a lower strike price. The option expiration date and the strike price are two key factors that you really need to think about before selling a put option, as they determine the amount of money that you're going to bring in when you sell that put option. I typically prefer to sell put options that are 45 days long in terms of the expiration date, and I like to sell put options that are anywhere between 10 to 15% lower than the current price of the stock. Okay, so we mentioned that the stock is trading at $55 a share, and we're selling someone else the right to sell us 100 shares of stock at $50 a share. So a question that comes to mind is, why would someone else pay for that right to sell us 100 shares at $50 a share when the stock is currently trading at $55 a share? And the best way to think about this is almost like they are buying insurance from us. When you buy a new car, you're going to buy insurance for that car, even though it's in perfect condition. And you do this to limit your exposure in the event that the car gets into an accident. And it's very similar as to why they're buying the put option from us. They're buying protection against the stock price going below the strike price. They know that no matter how far the stock goes down, they'll be able to sell 100 shares of stock to us for that strike price. Even if the stock goes to zero, they can sell 100 shares of stock to us for the strike price at any time between now and the expiration of our contract. So by selling put options, we're acting like an insurance company that sells insurance against the stock price going down. Let's go back to that car insurance analogy for a moment. If I buy a new car and buy insurance for it and never get into an accident, the insurance company never has to pay any money out at all. They collect the premium that I pay and they don't pay anything out. And similarly, when we sell our put option and the stock price doesn't close below $50 a share at the time of expiration of that contract, we keep the entire premium that was paid to us and we don't need to buy the stock. So we keep that $100 that we got when we sold the put option and we don't have to pay out on the insurance that we sold. We can then determine if we want to sell another put option. I sell put options for a number of reasons as a part of many different trading strategies. One of the reasons why I sell put options is if I want to buy a stock that's currently trading at a higher price than I want to buy the stock for. And I could sell a put option at, say, a $50 strike price and get paid $100 to do so while the stock is trading at $55 a share. And by doing so, if the stock price closes below $50 a share at the time of expiration, I'll buy the 100 shares of stock at $50, and I'll also have gotten paid $100 up front to sell this put option. So my cost basis is now $49 a share because I sold the put option for $1 a share up front, or $100, and I bought the stock for $50 a share. So I'm subtracting out that $1 a share to get to my $49 cost basis. And to me, this is so much better than paying more than I want to for the stock, or just sitting around and waiting for the stock to come down and not getting paid for that time that I'm waiting. And there will also be times where I'll sell that put option for a strike price of $50, collect $100, and the stock never closes below $50 a share, and then I can just sell another put option. And this is almost like creating my own dividend payment for the stock without even owning it. And it's really nice to be able to collect these payments up front when you're selling put options. And on the topic of dividends, something that works really well with put options is selling put options on dividend stocks that are trading at prices that are too high for me to buy today. Because for me, when I buy dividend stocks, one of the key considerations is that I want to buy the stock when it's undervalued. So if I find a stock that's a good dividend stock, but is overvalued or is priced too high, I can sell a put option on it and determine the price that I'll buy the stock for, the strike price. And this is a good way for me to start collecting money up front by selling the put option before I own that dividend stock. Now, there are plenty of risks associated with selling put options. The stock price can go to zero. You can also be taxed at a higher tax rate because you're having short-term gains. But what I will say is that if you want to buy 100 shares of a stock, selling a put option at a strike price that's lower than the price that the stock is currently trading at is a really good alternative and is actually lower risk than buying the stock outright right now. And the reason for that is that you're collecting the payment up front, so you're lowering your cost basis already, and you're also going to be buying the stock at a lower price than it's trading for today because you're going to sell a put option with a strike price that's lower than the current trading price. Now, one of the downsides of selling a put option rather than buying the stock outright right now is that if the stock price goes up substantially, you only collect the premium that you sold. Whereas if you bought the stock, you would be able to make a profit from the price that you bought it at to the price that it's currently trading at. And that's something that you just need to consider. If you think that there's going to be a sharp move to the upside in the near term, then maybe it makes more sense to buy the stock. But if you're looking at things from a longer term perspective, or if you're looking at things from the perspective of buying undervalued stocks, selling put options is a really interesting way and really strong way to go about doing so. Selling put options is a part of a number of different strategies, and this is really just the building blocks here. If you like the idea of selling put options to generate income, check out this next video here where I talk about how to sell put options as a part of the wheel strategy, and it layers in covered calls into the put option strategy to generate even more income. All right, see you in that next video.